or you can email me and I can answer it after the webinar, info@zenwcs.com. My name is John Duffy. Thank you for attending. And let's begin. All right, what is investing? It's part speculating and it's part saving. So you're taking money now and you're setting it aside and you are putting it into something that you hope is going to be worth more in the future. The reason that we don't just hold on to savings is because over time, things get more expensive. So if you, for instance, had $200,000 now, didn't do anything with it other than hold it as cash, assuming about 3% annual inflation, in about 20 years, it would only be worth $108,000. And in 40 years, you're down to just under $60,000. So it is important to keep up at least with inflation, and ideally beyond inflation. Inflation right now is running pretty low. It seems highly likely that it's going to continue to do so for the foreseeable future. I don't think we're going to have any of that hyperinflation that we saw in the 70s, but we shall see. In the meantime, it's pretty low. Here's the effects of compounding. It was Albert Einstein who was generally given the credit for saying that the most powerful force in the universe is compounding. If you were to invest about $5,000 annually and 6% growth rate over the course of about 30 years, you would get yourself up to just about $395,000. So what is reinvesting? It's just allowing the dividends and any growth to continue to stay in the portfolio and for the dividends to reinvest themselves. Personally, I like dividends to generate and just sit there as cash for a little bit, because maybe on a rainy day, sometime the market is down like it is right now today. It's a great time to take some of your cash and put it into things when they're a lot less expensive than they had been even a couple of days before. The rule of 72 is a general rule of thumb. You take the number 72 and you divide that by your portfolio's annual return, you will get the number of years in which it takes to double. So if you have a 9% return, your portfolio should be about twice as much in 8 years. Let's see, math off the top of my head. If you've got 5, it's going to take 14 plus years. So the more risk that you have, the more reward over a longer period of time you have. Shorter period of time, like again today, it can be very volatile. That's why generally as people are approaching retirement, they cut down on the risk and they go for something a little bit more sure. We're going to look at some of those kinds of options shortly. This slide goes to show that you want to get started sooner than later, putting some money aside to, for retirement. The blue line there is if you started at age 20, and in all of these, you're just setting aside $3,000 a year, and it's growing at about 6%. The green is if you started when you're 35, and the orange there is if you started at the age of 45. Check chat real fast. Ooh. Hang on, I see somebody. I'm not getting the chat. Hang on a second. Well, let me come back to that. So you can see over the course of your lifetime, the younger you start doing the same thing as you're doing if you didn't start until 45, you're going to have a lot more money. This sort of chart always feels a little intimidating to somebody who maybe didn't start off when they were in their 20s. And, I think that the giveaway is it's better to start sooner, but it's never too late to start. If you haven't started setting anything aside yet, you should try to get it going. Start a rainy day fund, start kind of an emergency fund, give yourself 3 to 6 months of your salary set aside just in case something happens. And then after that, you should just start setting something aside. 401k, something like that. If you've got that option, especially if your employer matches, at least take advantage of the match portion of it. Get yourself some free money. Goals and time horizons. This is a big part of financial planning, which is what we'll cover on the next webinar in 2 weeks. It's helpful to kind of start investing along with a financial plan, because that gives you a sense of what you're saving for, what you're trying to accomplish, whether it's long-term or short-term, and then that kind of informs how best to invest. Again, if you're looking at something, maybe a long-term purchase or a large purchase, but in the short term, you're not going to necessarily want to go all stock, because the volatility is such that, you know, it could very well be in a market downturn when you need that cash. So, but as something like, for instance, I have a client who's looking at a good tax bill next year. So what we'll do is we'll set aside some cash now, and even though we're not going to get a whole lot on a CD, we'll at least earn something, and we know that because it matures at a certain date, we know that there will be a specific amount of money available at that time. Risk tolerance is, it's really important to know about yourself. Generally speaking, the younger you are, the more risk you can take. Risk is not so much about your portfolio is invested in all sorts of strange things. It really just has to do with you have more equity than fixed income in your portfolio. Equity is a little bit more volatile. If you think about a bell curve, it's just a wider dispersion. So you will have the larger gains over time, but in a short period of time, you can definitely have larger losses than something that's less volatile. So when you're thinking about it, you want to consider, you know, the immediate possibility that you might have a loss and whether or not you can absorb that. Your personal tolerance for risk. Some people, even though they're young, they just don't like the idea of their portfolio jumping around. So they might want to just be more conservative for their own personal peace of mind. Generally, there are 3 different types of risk tolerance that kind of break into different portfolio allocations we'll look at later: aggressive, moderate, and conservative. I think the risk portfolio tolerance sort of questionnaire is really important. I have a on my website, if you visit it, there is a button down towards the bottom that says something to the effect of, I think like free risk portfolio risk test or something to that effect. It's worth checking. It's a really small, short questionnaire. It'll give you a precise number between 1 and 99, what your risk tolerance is. And then that allows for a portfolio to be crafted to almost precisely match that risk. You can match it exactly, but of course, on a day-to-day basis, there's going to be some drift. But the idea is that I think the more precise you can decide what your risk tolerance is, you know, not just aggressive and moderate and conservative. The more precise you can get, and the more you're precise the questions you're answering are about. You know, if you could definitely make this much money in the next 6 months versus possibly this is the downside as a dollar amount, are you comfortable with it or not? That's really going to be more informative for you and for whoever is trying to help you with your portfolio than just are you aggressive or moderate. These are general kind of categories of investments, and starting from bottom, working your way up, you see that you are going up both the potential return on the y-axis and risk on the x-axis there. So they're not necessarily linear like this, but it gives you just a sense of what you're going to get a better return for, but at the same time, it is going to come along with more risk as defined by volatility, variation in the returns. And then you've got this trade-off. So generally speaking, if you have an investment that is generating income, it's probably going to be a little bit more stable than something that is really growth oriented. It's just kind of a trade-off. You know, companies like Apple that used to be a big growth story, at some point they started giving a dividend, and they became a little bit maybe more of an income source. They were a more mature company. They weren't experiencing the same sort of growth. They were figuring that at this point they're more of a service company. They probably have the market share they're going to have. And so stocks what I'm saying is can change over time as far as their risk characteristics. Types of investments. So you've got cash and cash alternatives. We'll go into each of these in the coming slides. Bonds, both cash and bonds, you would kind of lump together as fixed income. Stocks, which are called equity. You've heard of that as well. Other investments, balanced funds, all sorts of collectibles, things like that we'll get into. Funds aren't exactly a type of investment. They're a wrapper, and we'll get into that later. They're just a way, one methodology for investing either in stocks or bonds, but we'll cover that shortly. And 401ks and Iras, those are not investments per se. They are a tax-deferred savings vehicle for them, investment vehicle, but you actually need to select the investments in them. With 401k plans, you have a select number of choices that your company is giving you. In an IRA, you can generally invest in just about anything within there. Moving on. Cash alternatives, very low risk, very low return. This is like, I opened up a savings account for my 11-year-old son yesterday at the bank, and his savings rate is 0.02% annual return. So the trade-off for having cash and taking no risk is that you get almost no return on it. But if the main part is preserving your principal, that's maybe worth the trade-off. Cash and cash alternatives kind of include CDs, money market deposit accounts, money market mutual funds. These are all roughly supposed to hold their value at about $1. So for every dollar you invest, they're worth $1, and over time they go up just a little bit. And then treasury bills and things like that from the government, they have very low return, but they have low return because they're guaranteed by the US government. Since you can't lose on them, they're not going to pay you a whole lot. There's no risk to be taken. The alternatives are that you've got predictable earnings, even though it's almost none. They're highly liquid. They're basically cash, if not cash. Very little risk to your principal. Probably won't keep up with inflation though. So it's good for a short-term consideration, but long-term, you're gonna not want to just hold cash, as we saw on that second or third slide. Next, you've got bonds, another fixed income component. These are loans. You let the government or you let a company borrow money from you, basically, and they say, for giving me this amount of money, I'm going to pay you a certain amount of coupon, 5%, 3%, whatever it may be, it's stated. Generally, it does not change, although there are some that are floating rates, so that if rates rise, it might go up and might pay you a little bit more. They also have what's called a par value. They are worth a certain amount. You pay $1,000, and when it matures, and these all mature at some point in the future, they will pay you back $1,000. And in the meantime, usually twice a year, they pay you that half of a 6% or a 5% or a 3%, whatever it is. Normally you get 2 payments a year. Regular interval is traded like other securities. That's kind of yes, kind of no. They're not traded on the exchange. You don't have pricing up to the millisecond. You have to put in a bid request if you're buying individual bonds. You can sell them within the day, but it's not exactly like trading stocks. And sometimes, if the rates are not favorable, you're not going to get a favorable bid for your bond. They're going to offer you less than you might be able to get for it on another day. So keep that in mind. And that's if you're buying bonds directly. There are other ways to buy them. The value fluctuates, yes, but not nearly as much as a stock will. Bonds are fairly stable, again, because they have that par value. They have a set value that they're worth at some point. So they're not going to fall to zero unless there is the risk of maybe a bankruptcy in the company or even in the municipality if you're looking at government or municipal bonds. Types of bonds include the U.S. Government Securities Agency or GSE bonds. GSE is government-sponsored entities. That includes things like Freddie Mac, Fannie Mae, things you've heard of. They're kind of mortgage-backed securities. People who are getting a mortgage through the government, the government then in turn basically sells those mortgages as investments. It's not the collateralized mortgage-backed securities, which were a big part of the 2009 financial crisis. But you're buying you're buying an income stream of somebody else's mortgage when you're doing that. And they're government entity. They're not specifically government. You're not guaranteed repayment. They're generally low risk, but it's not like a treasury bill. Municipal bonds are great if you have a lot of money. Municipal bonds are tax-free income. The coupon that come from them are tax-free, federally at least. And for instance, living in California, if you buy California state-issued municipal bonds, you're not paying any state taxes on it either. So it's not a big coupon usually compared to other bonds. But if you are in a high tax bracket, there's a formula to determine what the taxable equivalent yield of the municipal bond is. It can be a lot higher than a standard bond. The higher you are up in the tax bracket, the more worth those have for you because you are saving taxes. It's a pretty steady income stream. It's a real nice way to basically have a lot of money work for you, like it's going to work every day and that's its job and you don't really have to do as much. That's what, you got a lot of money, that's the way to go. Corporate bonds, just from companies, from Apple, the same companies that you might own equity shares of, they also sell debt, and so you can get corporate bonds. All right, so advantages, they're a steady and predictable stream of income. Again, they're not nearly volatile as stocks. Checking time, we're running later than I want. Income streams are higher than cash alternatives, but their long-term potential growth is less than stocks. And they are lower risk compared to stocks, which is why they don't earn as much. Low correlation with the stock market, generally true. The idea used to be really that stocks and equities were two different sides of a seesaw, and if stocks were doing really well, bonds wouldn't be, and vice versa. If the stock market was in peril, that bonds would be doing really well. But what's happened kind of since 2009 is they basically moved together, especially when things are very stressful. Everything goes down because people are just looking for safety and selling whatever they can. So don't expect perfect correlation. It's definitely not -1 where it's going to exactly offset your equity. There is the risk of default from some of these normally, and that's where you get into bond ratings, and from AAA down to, you've heard of junk bonds. Those are below investment grade bonds. It means they have a higher rate of default, and because of that, they're going to have a higher coupon to entice you to invest in their debt. So there's a trade-off. You don't want to just recklessly buy a bunch of junk bonds without kind of knowing a little bit more about it, because you could be stepping into a pretty bad situation. The value of the bond fluctuates with interest rates. So if interest rates were to go up, if that 3% annual interest sort of thing goes up to 4 or 5%, if you had a bond that was paying a 4% coupon, you're all of a sudden not even keeping up with inflation. So the value of your bond is going to go down a lot. So they can be really volatile with interest rates. That's one of the things that they really move around to. That's what's actually happening today a bit. Lower risk means lower potential returns. And again, because they have that par value that at some point this is what they get paid back, they're not going to appreciate too much beyond that. Stocks. This is probably everything what you're most familiar with. You actually are an investor in a company. You have an ownership position. As whatever they do, good or bad, you are along for the ride with them. Percentage of the ownership determines your share of profit or loss. Yeah, kind of. It doesn't mean that the more you own, it just means the more stocks you have and it goes up, the more money you made, the more stocks you have. And if it goes down, the more you temporarily at least lost unrecognized gain. And you might have dividends on those, and those are generally paid quarterly if you get them. It's a nice way to reward you to hold tight to the bond, to the stock, and rather than trading it and again, that's going to be more with your mature companies as opposed to your growth companies. And of course, you can sell it for either a gain or a loss. Nice to sell it for a gain, but in a taxable account, you sell it for a loss, you at least get a tax credit for that. So it can be helpful for offsetting gains on your tax returns. Quickly, their common stock, which is what you're most familiar with. Preferred stock has some characteristics between a bond and an equity and a stock. Um, there's a par value for it. There's a maturity date. Um, it's a little bit different. Preferreds are kind of an entity to themselves. It's a nice return. It's a nice part of the portfolio, but I wouldn't try to buy those individually. There are lots of managers, mutual funds, et cetera, who do that. Small cap, mid cap, large cap, you've heard the terms thrown around. That has to do with the market capitalization size. So you take the numbers of shares outstanding, you multiply it by the price of the share at that given moment. That tells you the market cap of the company. There are different thresholds for what counts as a large cap or a mid cap. And there's mega cap and there's micro cap. So there's more than just those as well. And growth stocks are going to be more volatile. There's bigger ups and bigger downs. The value stock is something that's paying a dividend, so it's going to move a little bit less. Income stock is really going to be mostly about the dividend and a little bit of growth. Blue chip stocks are kind of those great companies, the Dow companies. A lot of them, though, over the years have underperformed and get kicked out of the Dow. So it sounds nice. It theoretically should hold up better in kind of a market upheaval, but they don't always, because again, correlations go to pretty close to 1. And American depository receipts, those are foreign stocks that are kind of made up as a wrapper for buying and selling in the Americas. Advantages, longest, highest long-term total return, absolutely. Those brief periods though where it can be terrifying, so that's why you want to make sure your time horizon is set. You've got ownership rights. You get to vote for boards of directors. They send you those proxy statements in the mail. They're very annoying. I've never voted for them, but it's a lot of mail. If you have a paperless option, please sign up for that, because you're just going to get catalog after catalog from every single stock you own. It can provide income through dividends, as well as capital appreciation, which means growth. And they're easy to buy and sell. There's a lot of things you can do with stocks that we won't get into too much now, maybe on the more advanced ones, but limit orders and some of these things where you can put in stops underneath them and say, you know, if the market comes down, if the price of this stock comes down, I want to sell it at this price, and you don't have to be actively monitoring the market. If the company's not doing well, your shares aren't going to do well. If the market's not doing well, your shares aren't necessarily going to do well. And it has nothing to do with your fault in picking that stock or the company. It's just sometimes everything moves together. Greater risk to principal. Unlike a bond, there's no floor to it. It's the lowest it can be worth is 0. So sometimes they get there. Not often, but you know, companies can really mess up. So you want to be prudent with your choices. And they're not really a good idea for short term. If you're trying to do something in the short term, if your retirement is just around the corner, you might want to back off the amount of them you have. You still want to have some growth to just kind of keep with inflation and above, but don't put all your eggs in one basket. Other investments, you've got real estate, whether you're owning it outright or you can invest in it through funds and all sorts of different things. We'll get into the wrappers here in a moment. Stock options, futures, and commodities are tricky, requires a lot of know-how, but overall, they're either a way to really hedge maybe your own positions to minimize losses, or you know, have a large leverage gain. It doesn't cost as much to buy options as it does to own the stock long. All that stuff that's been happening with GameStop, that's been people buying as long against short sellers, which we'll get into in another class. And collectibles, and along with that as well, precious metals and things. Collectibles, art, cars, all of wine, whatever. You know, if you really want to diversify your portfolio, you've got all these different options available. It should not just be a stock and bond portfolio. Okay, this is about kind of the wrapping of it. So you think about, you go to Chipotle or something, you're still going to get the soy rizo or whatever, and your lettuce and your cheese and your avocado, but you can get it in a bowl, or you can get it with a tortilla. So these are the wrappers. This is the tortilla or the bowl. You can buy bonds these ways. You can buy equity. You can buy a combination of both. Just about anything under the sun that you can own in a portfolio, you can buy through a mutual fund. Mutual fund, as the name kind of implies, your money is pooled with other investors, and there's a specific strategy that the mutual fund is following. It's actively managed by a team. There's charges within it. You don't necessarily see them. They're kind of sneaky that way. There are share classes. There are several, but basically you're buying like an A share. It's like you're buying a house. You pay a lot up front, maybe upwards of 5%, and every year thereafter you're paying much less. So the idea is kind of a buy and hold position. You want to normally crosses over in kind of the 8, 9, 10-year range. You have to hold it that long to make it worth it. Otherwise, you buy what's called a C share, and that's like renting a house. You pay roughly 1% or so every single year, and you can, whenever you get rid of it, you know, if it's 7, 8, 9, 10 years or less, it probably costs you less in the long run than if you bought an A share. Here's the disclaimer. You can read that later. Major investment categories. There's really everything. You've got the kinds we've talked about so far, and then you've got a balanced fund that's right in the middle. But funds can do all sorts of different things. They're not limited just to these. But again, as a wrapper, it's a way to buy access to these. International funds are going to be a little bit more volatile, emerging markets, things like that, longer or greater risk, greater potential return. Actively managed, generally, most of them are not passively managed. There's a team, and that's why there's a higher charges within these than what we're going to look at next. So I've covered these already. I'm going to go through. I'll cover on the tax inefficiency. As stocks inside of those mutual funds are purchased, well, more specifically, as they're sold, you will be charged a capital gain tax for them. At the end of the year, there's a capital gain tax that usually comes through on all of the mutual funds. It gets reported on your 1099s. That's why they take so long. You don't get them until like late February, mid-March. You start wondering if you're going to get them in time for taxes. They need to figure that out. The problem is that you might just have started owning a mutual fund, and for instance, Tesla's been in there forever and they're selling it now for whatever reason. You're going to get a good sized tax bill for never really having any advantage of having owned it for all of that growth. And that's just kind of the way it goes. Exchange traded funds are really kind of my favorite way to do a lot of basic market, allocations. This is a very low cost generally. What they do is they buy the same. So for instance, the S&P 500, 500 roughly, it varies a little bit. Different stocks, they will buy the exact same stocks with the exact same weighting. And so it has a one-to-one relationship with the performance of that index. You don't pay, when I said, for instance, that a C-share mutual fund might be roughly 1%, the big exchange traded funds that are following the Dow or the S&P or the NASDAQ are like 0.03% or 0.17, really low in comparison to the mutual funds, because you're not paying for a manager who's trying to outdo the market. You're just saying, give me the market returns over the long run, let me pay less for it, and I'm gonna probably come out, further ahead. These can be traded just like stocks. You can do limit orders. You can buy it on margin. You can short it. I wouldn't recommend it, but you can do everything you can with a stock. There's a ton of liquidity in these. There's a ton of volume for most of them. There are some really esoteric ones, but it's a pretty good way to do it. And you don't get those capital gains tax thrust upon you. So it's just a little bit more, it's a lot more tax efficient than mutual funds in many cases. Disclosure again, I'm sure your speed readers, you got through it now, so I'm moving on. Investing, the idea is that instead of putting everything, dollar cost averaging is saying, instead of putting, I wanted to invest 10,000 in something, I'm going to do it all right now today, space it out over time. I'm a big proponent of this as well. This hypothetical that it shows you is kind of maybe the example of somebody who's getting a paycheck, and they're saying that every single time I'm going to put in $300 per month, and whatever the share price is at, that's what I'm buying it at. So If it's at 30 bucks, I can only buy 10 shares. When it's down to $10, I can buy 30 shares. It's still $300 every single time you're investing it. And over time, you bought some high, you bought some low, and you can see there at the bottom it says your average cost per share is $17.24. If you had bought it all that first time, you bought the 10 shares, you did everything then, it would have cost you 30 bucks, and you have a much higher cost basis. You will have less growth potential if you're buying it high. And so dollar cost averaging is just continue to make small investments, break it up into 3, 4, 5 different groupings of what you want to spend. Or with something like your apps, your stash or something, where you just get a little bit, move some over from your paycheck or whatever it may be, and it's just going to invest it in your chosen portfolio. That's a great way to do it as well. Just don't worry about the price. It's nice when it's lower. I mean, it's scary to invest when the market's down, but at the same time, over time, it's going to come back up and you're going to have a lot more growth in that purchase than if you bought it near the top of the market. Okay, asset allocation. This is what really determines your portfolio success. It's knowing your risk, and then it's knowing your time horizon. All of that goes into determining how you should invest. And this is going to use 3 different examples of conservative, moderate, and aggressive, but of course there are so many shades of everything in between. But really understanding what you're comfortable with as risk and what you're trying to accomplish is going to help you as an investor know how aggressively, how much equity compared to how much fixed income you should be investing. So let's take a look at a conservative portfolio. You can see that, again, this is just a general example. This is not everybody does it this way, but it's a kind of a pretty close representation. So 50% bonds, 25% cash alternatives. There's not much growth, but there's not much principal risk there. So basically 75% of your portfolio is in fixed income, and then 25% of it is in stock. Probably enough to keep pace with inflation. It's probably paying you some income. So maybe somebody who's near retirement, this is going to be a pretty good idea for a portfolio. You'll have regular predictable income from it, a little bit more unpredictable growth, but you don't have so much of your portfolio in stocks, in equity, that you're going to have a big loss if the market tanks. Moderate portfolio is going to be closer to 50-50. There you go. I mean, that's not much more to say about that. And then an aggressive one is going to be kind of the inverse of that conservative, where you have a lot of it in stocks, in this case 75%, as opposed to conservative where it was 25%, and fixed income, the bonds and the cash alternatives make up the other 25%. These are just representations. Again, I encourage you to, if you go to my website, take a look at that button, click on that. It'll launch a short questionnaire for you, about 5 minutes, but it'll really give you a sense of what your risk tolerance is. And that'll help you down the road if you're looking at investing for yourself. It talks about why would you hire a financial professional instead of doing it yourself. A lot of people are very smart, very good investors, but at some point they just don't have the time for it anymore. And a lot of my clients are like that. They are familiar with the concepts. They have maybe done it successfully for a while, but now they don't want to deal with it every day. And I deal with it every day. I look at the market and thinking through it and dealing with investor psychology and all that stuff. One of the things you notice that you do not see on this list is financial professional beating the market. It's not our job. It's not possible. It's not something we could say definitively that we can do. As an investment professional, you might have as good of an opportunity as creating a portfolio that would do very well. My job is to make it very risk adjusted for you. Instead of just buying names that you like, I'm going to suggest diversified, and it's really taking your risk into account and all of your goals, as opposed to just putting money into different stocks. It's fine when you're younger and you have a long time horizon, and that'll go okay. But as you move through your life, you want to take a little bit less risk, probably. And that's it. So thank you very much for your participation and attendance today.